Here we go. Ladies and gentlemen, we are doing a special edition of 9x90. For those of you who track and follow our show, you may recognize the man, the myth, the legend that we brought on for you today, Eric Brody. Some of you have affectionately come to refer to him as the hot CRE Yoda, and others know him as Professor E. I think he's epic. Definitely call him Yoda. When I vanished in May and for 5 days and no one could find me because I was like brutally stabbed in the back, Brody's the one that I called. And I was like, okay, walk me through this because I have to get my head back in the game. And he's like, I got you. And he gave me this whole pep talk breakdown. But today we're not talking about that. We're going to shelf Carl Jung for a little bit and talk about distressed assets. Some of you may remember 2008 was a bloodbath for some and a gold mine for others. And today we are seeing the same market conditions, a unique opportunity for those who buy the dip and come into the bloodbath, buy the gold and exit. So Eric Brody's here to walk us through that.
Well, first and foremost, thank you. I don't know how many people get on twice, but I'm honored. When anyone is giving you nicknames and this and that, we grew up in Brooklyn, so we always had them. So it's apropos, works great. You want to call me Yoda, E Breezy, E, the Yoda of CRE, whatever it is, I am honored. I am honored to have a nickname. All right, so let's get into, look, at the end of the day, in my personal opinion, the same people are in real estate, the same ones that were investing, the same ones that are developing. Like capital is circling real estate. It's got allocations for it, but like everyone is in the real estate game. And what you and I are discussing is, where do we find alpha? What are we supposed to be doing? How are we making money, right? So in '08, when the markets had dropped and everyone is hurt, it's like many people were like, all right, so where's the opportunity? So I don't know if it was the same because, by the way, Adi, in '08, whether I was lucky, whether I was like in the matrix and I just missed all the bullets, I had no inventory. I didn't develop anything. I was done with everything I had in '07. I was looking for deals. The market tanks. And I'm like, I didn't even see that happen. You know what would have been incredible? Maybe if I had like a little bit of pain, I would have seen this next cycle coming, but I didn't, right? Because in the next cycle, as you're aware, I got hit with every bullet. Okay. So let's just talk about today's distress, right? I just had a conversation with someone about it. When the borrower is in distress, right? And I guess we should define sort of distress, meaning either you ran out of money, right? You can't finish the project. You went to refinance, right? You took out a construction financing, you took out a bridge loan, which just means a loan from 1 to 3 years. So you and I are talking about if you took out a loan from like 2021 to today, sort of higher interest rates, hoping for a better environment in the future, you go back to get a new loan and the rates aren't there or the proceeds aren't there. So that means that whatever you're doing, the income you're creating cannot support the debt. So now you're like, oh my God, what do I do? Right. And the borrowers are now suffering. And you're seeing it front page news, Real Deal, Commercial Observer. Everyone is, every other day someone's suffering, which creates opportunity. So what is the opportunity? And it's hard for people to understand or communicate because the people that are in distress, the borrowers, the developers, used to be sort of everyone's hero. Like, oh my God, you're the general moving this army. They're in distress. So the opportunity is not from necessarily the borrower, right? Which sort of changes it, which means sort of like the market, right? The developer, the landowner, right? They're the ones in distress. So then the question is, let's look at the capital stack. So then if the borrower is distressed, is there a way where you can give them money in front of their equity, right? So almost being like a parasite, although they call it rescue capital, what a misnomer. But think about it. And by the way, there's no judgment here. And this is the lens of reality, right? Let's take all emotion out of it, that you love the borrower, you love the developer, you love the lender. Forget about that. Let's just look at it from like an economic business perspective. You borrower are the at most risk dollars, then you have debt. Can you insert yourself past the debt, meaning that the asset is generating enough that there's a return after debt service to save it, meaning the gap, the lender's like, gave you 10 million, the new lender coming in is like, I'll give you 8 million and you're the 2 million. Okay. Can you make a return on this little gap, right? This rescue capital on the 2 million. That's an opportunity, right? That's something that's out there. You're seeing tons of funds. You're seeing Blackstone, BlackRock, and everyone else raising money for this type of placement. The question is, can you find the deal flow on that? Not very easy. Okay. So in the past, it was on the market. You were buying land, you were buying buildings on the market. Today's market is sort of under the kimono, right? The distress that isn't on the market yet, but you know that these borrowers and lenders are now having issues getting paid back. So the first is rescue capital, which is preferred or mezzanine financing. That's an opportunity. Another opportunity is, how about this? Forget about the equity. The debt on the deal is worth less than the amount that they gave to the borrower. And we're seeing a lot of that as well. And it's not in the other financial crisis, which was residential, it's in commercial, right? So the lender gives you, 60 cents on the dollar of your deal, but now it's worth 50 cents. So imagine that. The lender is now in distress. That's another opportunity. Because as we were discussing the other time, lenders leverage, right? So you thought the lender was big money bags. They're leveraging to put in less dollars because a lender, just like any developer, is also a syndicator in this short term 1 to 4 year, 1 to 3 year debt. That's another opportunity we're seeing. So there's all this restructuring, okay? All this restructuring, and you can insert new money and wipe out equity or lower debt. That's one thing. But what happens when the lender looks to the borrower, developer, and says, you're not the best custodian of the collateral, meaning they don't like you anymore. And their investors are like, you need to be the owner of the asset. Okay. Before we do anything, we need you to be in control. So now I was a lender. What does a lender do? I give you money. You give me my money back plus an interest rate. It's not happening. I want to wipe you out. So you're seeing people get foreclosed all over the country. Okay. They're the developers, the syndicators getting wiped out, front page news, personal guarantees, like all of these nightmare things. That one guy, Cohen, they're taking his boat. I don't know if I feel like horrible about it, but like taking away who and what he was. But now the lender owns it. So the debt has now become equity. Okay. They're now the owner of it. Right. And they're now saying, what do we do? Because remember, most of the time, the most accretive person to build or develop or to finance or to work any of the business plans that have been created was this borrower. They were the most credible party, but now they're not there. Now the lender owns it. Not many lenders have this infrastructure to asset manage, finish buildings, lease up buildings. That's another opportunity. The lender now owns it and needs to get it off their books. So they've wiped out the equity, they've lowered their expectation, and now you can buy at this lower level. These are the ways in which people are trying to find opportunity in this distressed marketplace. I hope that made sense.
Yes.
And by the way, there's probably more that I don't even know, right? These are the ones that I'm seeing sort of like right now. What am I seeing? One of my greatest friends is a special servicer. Okay. Imagine he's a special servicer. What a great opportunity where he sits today. Why do we have special servicers? Because lenders, as I said, aren't asset managers. They hire third-party companies. You may have heard of Rialto. They're like the biggest. They hire these companies. He's like one of the smaller ones, but they're calling him and be like, we've got all these loans that have a problem. We need you to take over these loans, you know, hire the attorney, pressure on the borrower, try to restructure. So he now sees the distress. So what's his opportunity? He can put together a new fund, buy that loan, foreclose and sell and make money. He can work it out with the borrower. He can sell this group of loans to someone else. So that's like a really interesting party that as a real estate professional, when you were looking at hard and real assets, you didn't even know these people existed. That's an amazing business right now. So he's making fees on managing these assets. And then sometimes he becomes the developer. He syndicates it. He buys these loans. He works through them, and then he sells the asset when he gets to it and he's making a fee. We're looking into that. That sounds like a great business that we're seeing. What else are we seeing? Half built buildings, right? we're developing a few buildings where the lender foreclosed on the borrower. The only reason the lender is working with us is they were half built. And when you go to the market on a half built asset, every new buyer is like, yeah, it's worth pennies on the dollar. And the lender's, no, it's worth so much more. And it's like, yeah, when it's done. So they don't have asset managers. So they came to me. I found them new money. So we borrowed money. I made a fee. And then we're finishing the development, making a fee. So that's another thing that's out there in ways to make money sort of in the distressed marketplace. Um, oh, and I mean, look, when we talk about it from different perspectives, because look, if you have $1 billion today, you probably can buy massive loans at a discount because you're cash ready. So that's another way that they're getting in. And we're seeing that across the country, and the opportunity there is huge.
So, okay, let's pause and take this from the angle of you just joined as a senior advisor in Heritage. What can investors expect us to be doing with your leadership and you navigating, steering where the capital goes in this unique environment, in this unique situation?
Yeah. So first and foremost, like imagine having dry powder in this moment is what Heritage is doing and has done. So let's just talk about first and foremost raising capital in a distressed marketplace, because the same people that were investing in other funds that are getting rocked right now are like, the time is right. So that's like it's like doubling down. But I think in doubling down, if you're thinking in bets, that's the greatest time. So the fact that Heritage has raised this money saying, look, we have access to these opportunities is huge, right? Because you now are coming in with fresh capital at a moment that like fresh capital gets to pick and choose what they do.
Yeah.
Now, being a senior advisor for Heritage gave them another sort of opportunity in vein, which was, oh, we can look at assets that are half built, that aren't complete in construction, because we have this arm that understands what the costs to complete are, what the nuances are, what their basis will be, because the underwriting on new construction is what people most fear, or on big renovations. So now Heritage is like, all right, we need to find the parties that are credible in each sort of category. And in the construction and development asset management, which I said to you, most funds don't do it, Heritage is like, yeah, one of our main components will be we can take over half-built buildings. So now Heritage has capital and it has expertise. So now it's like, what are we looking at? What's working right now? So with different perspectives and in different areas, like New York, it's like, yeah, tons of bridge financing, tons of opportunities to wipe out the equity, lower debt, finish assets, and stabilize to yields that we haven't seen since like the 90s. Meaning that when we stabilize it, we're doing so well that we can refinance it in today's market, and it makes money for us because we're buying after everyone got hurt. Or the article came out about Florida where developers are slowing down, right? What a great moment. We know Miami has a critical path that is definitely going to absorb units, like it's true. But what about these developers that took land loans? It's like they took 50% land loans, and you're like, yeah, like you're going to be SOL, right? And then the debt that gave them the land loan is like, what am I doing with this? I borrowed on land. I'm not a land developer. So now Heritage gets to come in and say, this works really well as a rental, as a condo, and gets to look at a new business plan where the basis in Heritage last dollar is half of what the other developer was. So you can take the risk. So those are the things that we're looking at with Heritage and why we're an advisor. Or how about, we know it's half built, a medical facility that already has leases, but the developer midway through is out of money. So then the lender is like, well, we're not finishing it. We're like, yeah, we'll buy it at a discount. We'll finish it. And there already are leases in place, meaning you're finishing to a return that is there and works. Like you're not taking that risk. You're taking execution risk. So these are all like some of the benefits, I think, today of having capital and being able to find opportunity.
What I loved was when I was in high school, my uncle used to tell me, Adi, you never want to be the first developer. You want to be the third developer who's going in with the rest. And I was like, well, when will I get an opportunity to do that? And here we are, 2025. And I was telling my uncle, I was like, yeah, so I'm going to do what you told me to do in high school, like decades ago. He was like, with who? And I was like, Brody. And he was like, the guy who did 40 buildings in like Manhattan area. And I was like, yeah, that guy. He's like, you got a Titan on your team. And I was like, yes, I did.
No, look, I appreciate that. And it look, the stars have to align and come together. I needed to be a free agent. Otherwise, I just would have been I would have been continuing to develop, right? Like so all of these things happen for a reason, you know? Being in distress and now understanding it had to happen to me in order to have that value. And that's why you call me Yoda now. It's like, yeah, it's called wisdom, which by the way, I wish I didn't have to have it. I would have taken the blue pill, but you know I didn't. So here we are, right? But yes, this is an incredible opportunity. Look, think about it this way. You and I are looking at new deals where we don't have it's not like sort of like swimming with like a suit on and all this clothing on, right? Like we are sleek, we shaved our bodies, like we're moving. What? Interest rates, we know where they're going to be. Maybe they go up, but when we're underwriting, our sensitivity analysis is like, here's interest rates, put it up a little bit, and it still works. Otherwise, why are we doing it? We don't have to take that risk today. We need to take it and say, if it moves, we're still good. But if the rates go down or anything goes in our favor, it just widens our yields and making us look smarter and smarter and smarter and smarter because our baseline is look at all the shit storm that's happening today and it still works at that number. And then if we get any lift, it makes us, oh, you guys knew and we're predicting. It's like, all right, you know, it's a prediction. We're trying. We think.
Yeah, I mean, I think that's one of the benefits to having been in this arena for 100 years is we know when to look for cycles. We know when the blood when there was blood in the water starting in May, people were like, "Adi, what are you doing?" And it was like, "I'm waiting." And they were like, "Waiting for what?" And it was like, "I'll tell you." And then June, they were like, "Adi, what are you doing?" And it was like, "I'm waiting." And they were like, "What?" And it was like, "There's not enough blood in the water yet." And then boom, this week, I was like, "Guys, now's the time that we move."
Yeah. Listen,
So
it takes discipline too. You know, you want to make a move, you want to do something, right?
yeah,
Like it's not, you don't want to sit on your feet, but that discipline will now be rewarded.
yeah, yeah. And I was remembering, do you know Hunter Thompson?
The author, the, what is that? Fear and
Uh,
Loathing?
no, capital raising.
Oh, okay. No.
He was talking about how he started his career um, during the 2008 recession, but he was like brand new to real estate, so he didn't understand like how to make the most of the blood in the water, how to explain to people why it was the best time to enter, and he was pitching to a lot of like non-real estate people.
Mm.
But this is the time where people make that multi-generational wealth, um, and we've built the A team.
That's correct. I completely agree with you, right? If I was lucky enough to miss the last cycle downturn, this one hit me, but now you're seeing it come back. And by the way, it stayed down for a while. Like this isn't, this is 2 days. Like real estate's like the Titanic. It does not move quick enough. It's not like a jet ski, you know, like it takes a long time. And people bet when Corona hit that that was the bottom. Then interest rates rose and you're like, nope, it's just starting. And now you're seeing it because it's cycling through. Like the law takes forever, you know, foreclosure takes time, and it's all now cycling through. People have suffered long enough. They want to get rid of the hangnail and be able to put their capital work in things that are actually making money, right? So this is that moment.
Yeah, and doing the 7 year for the fund instead of 3 to 5 years will give us time to get everything back up to a nice spot. Whereas you
Oh
see,
yeah. By the way, if it was, I think you'd be fine at 3, 5 is great, and 7 is just giving you flexibility because maybe the bottom line is the last cycle was, you know, 15, 18 years. Like we'll be fine. You may be able to recycle the capital a couple of times, but we'll
yeah,
have to have pitted. Maybe distress will be over. But the answer is like this is the moment. You just got to pick and choose. That's it. You got to pick and choose the ones that work. And then at the end of the day, you and I are marketing and we're great marketers. The opportunity and the bat signal has to be out there for the deal flow to come to us, which is happening, right? We're looking at, what do I say? About 500 million in deals a month right now, and it's going up. It's at 210 deals last month. Like I need like an AI to underwrite faster for us. You know, it's like just so
yeah.
much we're being inundated.
I love. There was someone who was trying to do this. He was like, "What are you guys doing at Heritage?" And I was like, "I called the CEO of a bank." And he was like, "You did what?" I was like, "Well, he happens to be a godfather, and he said I could look through his distressed assets to see what I want
Yeah.
to cherry pick."
Yeah, exactly. Right. Like that's what's
Yeah,
fascinating. It's about access, right? It's about the underwriting of it and then the execution. But the first one is access, which is fascinating right now. Like I think that that changes. There'll be higher access and lower
no,
barriers for
no.
entry one day. But in this moment, we have access. So I'm not, I'm going to take advantage of it.
Yeah, I don't think access will ever open up the I don't think access to certain people will ever be like Walmart.
Yeah, it's because you got to imagine if you're a lender or you own the asset now, like that means you did something wrong. Like, and by the way, no blaming and no judgment, but the reality is you had a responsibility to put out money and get it back with an interest, right? With your interest. It didn't happen. You now have it. It's like they don't want to scream, we did 100 loans and 10 are in big trouble. You're like, wow, that's not a good asset manager or banker. So they got to keep it real
Yeah.
quiet on the DL. So they need to be people who are like understand the nuance of it and keep them safe, not screaming, oh my God, this lender is in trouble. You know, they don't want to hear that shit.
And we get paid for our silence.
Yeah.
Yo, just pass me that thing you broke and I'll fix it.
True.
like kids who like played soccer inside the house and broke mom's vase. Like you have the CEO of a bank passing the broken vase to their friend who's going to quickly like glue it back together. Be like, look, we have this amazing return for our investors, and they get to pretend that they didn't break the vase.
Exactly. All right. Well, it's 12:30 for us. We
Yes,
squeezed this in because you and I know we got to get it out. You know,
I
tell
know.
the world.
Yeah. Okay. So everyone that's in the investor list for Heritage, you will see this dropping this afternoon in time for you to watch it quickly, make moves and buying decisions based on this. And I will see some of you in person tomorrow. Senior Vice President has a birthday. Senior Vice President of Tourist. And the rest of you, I will see you either in Miami or New York in the coming weeks. Thanks so
Let's
much.
go.
Take care. Bye.
Talk to you. Bye-bye.